All right, this is a red alert briefing. A massive deadline is bearing down on the entire U.S. energy storage sector, and it is forcing Tesla into an all-out breakneck sprint. Let's break down exactly what's happening, why it's such a huge deal, and what it means for the whole industry.
The clock is ticking. In just 8 days, a critical legislative deadline hits, and it's going to change the entire economic landscape for energy storage projects in the United States. This is the final countdown. There's no turning back.
And here it is. This is the reason for the mad dash. The 30% investment tax credit, the ITC, for standalone energy storage is confirmed to expire. The legislative safety net that has been fueling this industry is being pulled away, effective December 31st.
Okay, first, let's establish the ground truth here. Any hope of a last-minute legislative save? It's gone. It's not a possibility anymore, it's a certainty. The industry is officially going over the tax cliff.
And look, this isn't a rumor or speculation. This is confirmed. The Senate Majority Leader's office has put it in black and white. There will be no floor vote before the recess. The extension is dead, period.
And just so we're all clear on the stakes, that ITC is a massive 30% credit. It's literally what makes the math work on these giant battery projects. Losing it overnight isn't some gentle slope. It's a sheer drop. It's a tax cliff. And the entire industry is about to find out what that feels like. So how is Tesla reacting to this hard deadline? They've initiated what we can only describe as an absolutely massive 24/7 logistics sprint. This is an all-hands-on-deck emergency response.
Our intel confirms a red shift has been activated. That's code for emergency overtime. The Lathrop megafactory and their key logistics hub down in Brookshire, Texas, are now running around the clock. Their one and only mission? Get every single megapack out of the yards and delivered before that December 31st deadline hits. Now, you can see the strategic trade-off they're making right here. They are willingly taking a hit on their gross margin, dropping from around 31% down to the high 20s to pay for all this overtime and expedited shipping. Why? To guarantee a significant beat on Q4 revenue. It's a calculated sacrifice for a much bigger immediate win. And just how big is that win going to be? We're now projecting that Q4 segment revenue will absolutely shatter previous estimates. We're talking potentially north of $5.5 billion. This is the pull-forward effect in full force, with developers scrambling to get their hands on product to lock in that 30% credit. But, this story is way bigger than just Tesla. This deadline has triggered what we're calling a clearinghouse event for the entire industry. It's a moment of truth, and it's separating the pros from the amateurs in real time. And this slide right here tells the whole story. It is night and day. On one side, you have Tesla, who is actually delivering. On the other, you've got competitors like BYD and CATL, and they're stuck. They're telling customers, sorry, you're looking at 4 to 6 week delays because they're caught in port congestion. Tesla isn't. And that is exactly why we're calling this a clearinghouse event. This tax cliff isn't just a deadline. It's a brutal stress test on the entire supply chain. It's exposing who can actually execute under immense pressure and who can't. And not everyone is passing this test. So you gotta ask, how is Tesla pulling this off? Well, they've got a few huge advantages. They use their own dedicated shipping vessels, so they just sail right past all the container port logjams. Their vertical integration means they can flip a switch and go to a 24/7 red shift almost instantly. This whole event is basically crippling rivals who can't deliver, and it proves why execution reliability is everything. Okay, that Q4 push is absolutely incredible. But, and this is a big but, we have to issue a warning now, because after the sprint, there's always the hangover. We need to talk about the vacuum this is going to create in the first quarter of 2026. You can see that hangover effect right here on this chart. After a truly monumental Q4, we expect a dramatic sequential drop in Q1. All of that demand was pulled forward into 2025 to capture that last bit of the tax credit. That leaves a massive hole, an air pocket, as the subsidy just evaporates. Now, this is the absolute key takeaway for anyone watching this space. The Q1 drop is not a sign that demand for energy storage is collapsing. It's not. It is a predictable, regulatory air pocket caused by the subsidy ending. The fundamental need for grid-scale batteries has not changed one bit.
So what does this mean? It means we have to change how we think about this market.
at least for the next few quarters. The story is no longer about simple, straight-line growth. Right now, it's about volatility management. The winners are going to be the ones who can navigate these sharp, policy-driven swings.
And all of this brings us to the one question that really matters now. The training wheels are off. The subsidies are gone. Now we get to see who has the tech, the execution, and the bankable business model to survive in a post-subsidy world. So, with all that said, who is truly built to last?